There are 3 core financial statements which are key to every review, and we'll cover each of these statements in detail in this class. The first core financial statement is the income statement, which you may also hear referred to as the statement of earnings or the profit and loss. The income statement is a periodic record of a business's revenues and expenses, and when you subtract expenses from revenues, you get net income. We'll cover the income statement in detail in section 3. The next statement is the balance sheet, which is a record of a business's assets, liabilities, and equity as of a specific date. Assets represent economic resources that a business owns. Common examples include cash, inventory, real estate, and so on. Liabilities represent claims on a company's assets by third parties. Think of a liability as a promise to pay in the future. Some common examples of liabilities include short-term payables, credit cards, bank loans, and so on. And finally, equity represents funds which are invested into the business. The balance sheet must always be in balance, and for that to occur, assets must equal liabilities plus equity. The balance sheet contains 3 additional schedules that provide additional detail into asset and liability accounts. These include the net working capital schedule, the depreciation schedule, and the debt schedule, and we'll cover the balance sheet and each of its supporting schedules in section 4. The third and final core financial statement is the cash flow statement, which contains a record of how a business is generating and spending cash. The cash flow statement differs from the income statement in that revenues and expenses don't always equate to cash generated or cash spent. The cash flow statement is broken out into 3 categories, which helps us understand where cash is coming from and where it's going. And we'll explore the cash flow statement in further detail in section 6. Now, each statement is interconnected to the others in several ways. So for example, net income from the income statement feeds into retained earnings on the balance sheet, and it also ties into the cash flow statement under operating cash flows. Let's switch gears for a moment and talk about financial reporting quality. Financial reporting quality refers to how reliable a financial report is to an analyst or an investor, and by order of least to highest quality, financial statements can be internally prepared, compiled, reviewed, or audited. Internally prepared financials are simply those which are put together by an employee of the company, and these are generally regarded to be the lowest quality because they aren't subject to any type of additional review by a third party. Compiled financials are next on the list, and compiled financials are those which are put together or compiled by a third-party accounting firm, and though compiled financials are put together by an outside party, they aren't subject to any type of additional review. Next, we have reviewed financials, and like the name implies, reviewed financials involve a review by an outside party to determine whether the financials are reliable or not. This process generally involves a limited review, but it does provide some additional assurances as to the quality of the financial statements. And finally, audited financials are the highest quality on the financial reporting spectrum. Audited means that the financials have undergone a rigorous verification process by an outside party to determine their reliability and accuracy. The Securities and Exchange Commission in the U.S. requires that publicly traded companies have their annual financials audited because audited statements provide the highest assurance to investors that the financial information being presented is true and accurate. Now, for reviewed and audited financials, it's also very common to find additional commentary from management into the company's performance. For public companies, management is required to provide what's called the management's discussion and analysis, and we'll take a deep dive into this concept in this course. For now, let's take a look at debits and credits and how they relate to financial analysis. I'll see you in the next video.